I think stocks can go down. I mean, this year, our base case is that there will be a 20% decline at some point. But the way we tend to view markets is markets will probably peak on good news, and they bottom on bad news. So war is almost universally just a cadence of bad news. I don't think that's what causes stocks to go down. In fact, our team looked at the last 8 major war conflicts, and stocks almost always bottom at the beginning of the conflict. So, I mean, remember World War II? I mean, sorry. If you study World War II, none of us were trading World War II. That was a long war, and it was actually a bull market. I mean, wars tend to be good for the economy.
Tom begins by addressing the dominant sentiment, uncertainty. Investors are understandably uneasy about geopolitical risks, particularly tensions in the Middle East and the possibility of escalating conflict. But here's the key insight. Markets are not reacting the way fear would suggest. Since 2020, markets have endured what Tom describes as a series of black swan events. The COVID-19 pandemic, global economic shutdowns, the fastest inflation surge in modern history, aggressive central bank tightening, and ongoing geopolitical instability. Despite all of this, the S&P 500 has consistently rebounded. This resilience is not accidental. It's signaling something deeper. Markets are forward-looking mechanisms, and their strength suggests that underlying economic and corporate fundamentals remain intact. Tom argues that instead of focusing on headlines, investors should take their cue from the markets themselves.
If I was an investor, when I look at the environment, it's very uncertain because nobody wants war, and nobody wants problems in the Middle East that could really spiral. But as much as that's our gut reaction, I think when you look at what markets are doing, they've been very resilient. This is arguably the 7th black swan we've thrown at the market since 2020. From COVID to the basically shutting down the entire economy to the fastest inflation cycle in history. I mean, it goes on, and the S&P has been resilient every time. So I do think investors should take their cue from the markets and realize, I think the S&P actually wants the PE multiple to expand. And strangely, I might even add, I think oil prices being high is actually good for U.S. stocks. I did check Kalshi and Polymarket, and betting markets or prediction markets are expecting oil to be 100 even through June and past June. So I think we probably should assume oil, and it's a prolonged period of high oil. But now this is not saying it's always true, but I do think high oil has 3 reasons it's good for equities in the U.S. One is the U.S. is an exporter. So we are actually, as an economy, a net beneficiary of higher oil prices. The second is it's a relative issue, but the U.S. as an exporter, but China and Asia and maybe whoever we compete with economically is a net importer, we start to look better or stronger on a relative basis. So it's a flows back into U.S. equities. The third is that if global growth stalls because of high oil, which I think it is likely, investors want to own growth stocks. And actually, the U.S. stock market is basically 80% a growth index. So it makes Mag 7 and the cryptos and the software stocks look better. And that's what started to outperform over the weekend and actually Monday. And the last reason, and it kind of, I think, important, is that the Trump put only applies to U.S. equities. So I think high oil helps equities, or if you're getting bearish because of it, you shouldn't get too bearish on high oil. Well, I think it's giving us a lot of reminders, because there are, I think, 2 things that we usually advise our clients, two of many things. But one is this sort of idea of the rule of 10 best days, that if you don't, and I've heard Josh Brown call it time and market, but if you take out the 10 best days, the 10 percentage one-day gain days in each of the last 10 years, the S&P's average return drops from 16% to basically negative. It's almost 2,000 basis points of your return every year, or 20% comes from just 10 days. So if you feel like you're going to time the market because you're worried about geopolitical risks, unless you've got perfect foresight, you're going to miss the bottom, and that's what happened last year. And the second thing that we always advise our clients is this idea of what they call in Asia kiki, which means crisis is actually two words concatenated. It's danger and opportunity. I think investors are too quick to point out danger. I saw that over the weekend, like all these doom tweets, and people were getting oil prices through derivatives over the weekend. Like, you know, on Hyperliquid, it was oil hit 118, and everybody thought the economy would unravel. You have to think of opportunity whenever there's danger. So if you see high oil, you should also think, how can I benefit? And it's not just buying oil stocks, but it turned out to be buying the Mag 7. I think stocks can go down. I mean, this year, our base case is that there will be a 20% decline at some point. But the way we tend to view markets is markets will probably peak on good news, and they bottom on bad news. So war is almost universally just a cadence of bad news. I don't think that's what causes stocks to go down. In fact, our team looked at the last 8 major war conflicts, and stocks almost always bottom at the beginning of the conflict. So, I mean, remember World War II? I mean, sorry. If you study World War II, none of us were trading World War II. That was a long war, and it was actually a bull market. I mean, wars tend to be good for the economy. In some ways, there's already been a bear market because software has had a drawdown, and the withdrawal of liquidity, you know, the amount of selling, and then the short positioning is what you usually see at the height of a bear market. And we know the Mag 7 actually has become untouchable for many people. And we know everything correlated to software like crypto has declined. So I think basically half the stock market has been in a bear market already. But the reason I don't think this is the bear market is too many people have turned bearish. So, you know, I think markets, like if you think about late 2021, and we missed that decline, that was a time when people were quite optimistic and the market was falling in the face of pretty good news until it turned really bad. And I think that that's more likely happening later this year because, you know, we do have things that can cause investors to flip from being optimistic to scared, whether it's a new Fed. We still have a lot of AI spending. There could be new doubts emerging. So I'm kind of in the camp that we're going to be resilient through this war headlines and make our way to 7,300.
Despite their dominance, Tom suggests that major tech companies may actually be undervalued relative to their fundamentals. These firms have exceptional balance sheets, low borrowing costs, often lower than governments, strong competitive advantages, or moats, massive global reach. Yet, their price-to-earnings ratios are often lower than more traditional companies like Walmart or Coca-Cola. This mismatch suggests that there may be room for valuation expansion, especially if growth continues.
Like as I think about later this year, so we have a process to nominate a new Fed, which has happened, but then confirming the Fed. And then the Fed sort of starts to make his first set of public communications. And history shows that every new Fed chair has been tested by markets. The median drawdown is 13% within the first year. So let's say that starts in the late summer, and exactly as you said, it's almost in a quagmire, a no-win situation, because how does he convince the market that's worried about oil and inflation, but also private credit being weak, and an economy that is so confidence-driven, and maybe an administration that makes investors pretty leery? It's a very tough job. So I can see that being the makings of a pretty big drawdown later this year. The easiest situation for the new Fed would be if the market was already down 20%, and then he starts to make his first statements, then he can sort of be dovish, right? But if the S&P is around 7,000 and he's coming in, and you're exactly right, we don't have visibility on labor and inflation, I could see how the market will test him. But I think at this moment, I don't think markets are sort of pricing that. I think they're pricing in a lot of concerns, as you said. They're worried about AI and the amount of spend. I think people are overly worried about AI capex. I don't think the numbers are that big yet. They can get a lot bigger.
Not that big yet?
Yeah, I'd say
Like $700 billion this year, Tom.
Yeah, so something to keep in mind is someone looks at 700 billion and thinks it's a huge number, but globally, we spend almost 10 billion on construction activity, and like almost $5 billion on cars, and like gold prices in a single day move almost 1.5 trillion. So like the total AI capex this year is 4 hours of gold movement. Like, gold moves, the network value changes by about 1.5 trillion a day. So I think AI spending is still small in an $80 trillion economy. I mean, I think Mag 7, we know are widely held stocks, and so they're used as proxies for liquidity. So whether it's a global investor who's long US, they're owning the Mag 7, and a lot of hedge funds can only buy large liquid stocks. So the Mag 7, really occupy a lot of portfolios. But the valuations have become ludicrously cheap. For instance, the Mag 7 are still the highest debt-rated companies out there, with the and Oracle's not a Mag 7. So their cost of money is cheaper than many governments. I mean, in other words, Meta can borrow cheaper than like most of Europe, and Japan, and so stocks should have a PE multiple that's above the cost of debt of a company. So they should all be 30, 33 times earnings. I mean, even like an NVIDIA, but they're all trading in their 20s, and they trade at half the PE multiple of like Costco and Walmart or Coca-Cola. I mean, if someone says the moats on Costco and Walmart justify their PEs, I mean, then the Mag 7 have a proportionately good moat. I mean, I think the multiples have a lot of room to expand in the Mag 7. Yeah, I mean, I think the word circular is providing a negative connotation of what's happening. The reality is that AI spending can only be accomplished by large companies. I mean, like, it's not like Meta can buy chips from like mom and pop chip makers, or power. All this infrastructure requires, large-scale proportionate players. So it's almost impossible for this not to be circular. I mean, it's the same way, like if you look at the oil industry, there's 8 majors that buy oil. So globally, oil prices are set by basically 8 majors and refiners, but we don't say oil's a circular business. There's only certain people that can buy the oil and refine it. And I think that's the same of Mag 7. But I might say that there's no shortage of actual capital that wants to fund AI. For instance, OpenAI is doing a huge raise right now, like over 110 billion. And I've talked to many allocators. They can't get access to that because so much has already been spoken for. It's basically impossible to get access to the cap table of OpenAI.
Tom's message is both nuanced and powerful. While the world feels uncertain, markets are telling a different story. Resilience in the face of repeated shocks suggests that investors may be underestimating the strength of the current cycle. High oil prices, rather than being purely negative, could reinforce U.S. economic dominance. Meanwhile, structural trends like AI investment and capital concentration continue to support large technology companies. At the same time, risks remain. Market timing is dangerous, sentiment can shift quickly, and policy changes, especially at the Federal Reserve, could introduce volatility later in the year. The key takeaway for investors is this: don't let fear dictate your strategy. Markets reward discipline, patience, and the ability to see opportunity where others see only risk. As always, the greatest returns don't come from reacting to headlines, but from understanding the deeper forces shaping the future.